Good evening to everyone. Okay, a very good evening to everyone here. Thank you for joining me. Thank you. Really appreciate all of you for taking your time off your busy schedule to join me here today. And I know it's about nighttime, and I hope all of you had already have your dinner ready, and then be ready to enjoy. Be ready and also quite tired already after a hectic day of working. So I'll try to make this session here as interesting as possible while not going over the time as much. So before we start, let me just have a brief introduction for myself. I am Alvin. My name is Alvin, and I am the research analyst for FSMOne Malaysia. And today I'll bring about the topic discovering the benefits of regular savings investments with FSMOne. So before we kickstart our session today, can I just have an ice-breaking session? Can you type in the chat box as to how much do you think you need in order to retire? Just put in any figure that you like, just put it in the chat box, and either you can just DM me, or you can just put it to let everyone see. Yeah, just feel free to key it in the text box, the chat box. Okay, I saw some some said 3 millions, some are saying there are some saying like 20 billion, some are saying 100 millions. Okay, so actually the amount that you need in order to retire comfortably, it really differs between people. It really depends on what kind of life, what kind of lifestyle you are seeking. It can be a very luxurious one, or maybe for some people it can be just as simple as just meeting up the daily needs, and then you just you don't need a huge house, you just need some place that is cozy enough for you. So actually the average, because it also need to depend on what age you plan to retire and how long you plan to live, expected to live after your retirement. So for us to know, the average life expectancy of Malaysians is at around 75 years. So if you retire at the age of, let's say, 60, you may live out for another 15 years. So you need to financially plan for those years, as well as taking into account the cost of inflation, which will increase your expenses far more than you have budgeted for. So inflation refers to the general increase in prices of goods and services over time. This may cause you to the value of your money to decrease, and with inflation, a plate of chicken, a plate of chicken rice that currently costs around maybe 7 ringgit to 8 ringgit today may cost you maybe 9 ringgit or 10 ringgit in maybe next 10 to 20 years time. So the same goes for pretty much everything you pay for in your daily needs, like electricity, transportations, and even housings. So while inflation affects the cost of everything, from foods to transportation, it is the medical inflation that has been increasing rapidly in Malaysia. In 2020, inflation saw medical costs rise by around 13%. This will directly affect the cost of medicines and medical treatments. All of which you need to use as you age. And then Malaysia is actually facing an aging economy and aging population as people tends to live longer, and then you will also spend more on your medical expenses. So all of which, so especially if you have any chronic disease, medical conditions that need long-term full-time nursing care or even medical support equipments. So besides figuring out how inflation and healthcare will eat into your retirement savings, you also need to think about what your retirement will look like in order to better plan your retirements. So now let's move on to our main topic for today. So before we start, I would like to make a disclaimer first. Any investment products, any stocks, any unit trusts, any ETFs that I mentioned in this sharing today does not constitute to any of the investment advisory, and investments do come with risk. So please be aware, please do your research before you start your investment journey. So to start off, people can have very, very different dreams. And often, living a healthy, carefree life is many, many people's goal. But if we do not born in like a very wealthy family, more often or not, we had to depend on ourselves by working hard, good money management to achieve such goals. So every time after getting your hard-earned money, hard-earned salary, what will you do with the remaining amount after spending on necessities, commitments, and savings? Would you put those money into your fixed deposits with banks, your savings accounts with banks, or spend it on luxury items or investing? In fact, investing is a good option. You do not require a huge initial capital to start your investing journey. And believe me or not, with just a little amount on a regular basis, will be able to bring great fortune for you in the future. And that brings along my main message for today, which is wealth can be created by regularly setting aside some money for investments. Investing is a long-term game that will build wealth over time, with more often than not requires investing regularly. And experts have also agreed that setting aside some money aside for investments on a regular basis over time has the ability to make average people wealthy. So the basic concept for making money through investment is to buy low and sell high. It can be just as simple as that. Looking at this chart over here, if I just buy here, sell here, buy here, sell here, buy here, sell here, buy here, sell here, then I did make a lot of profit already, right? But why, even with such basic concept here, there are still so many people losing their money in the stock market? Because in reality, in order to do so, this requires investors to time the market, but then timing the market is often a loser's game. One can never perfectly time the market, not even your famous Warren Buffett or Ray Dalio. Or Ray Dalio is a very famous investors who manage hedge funds. So if we look into this example over here, where do you think investors will perceive the bottom to be if they want to time the market, if they want to catch the bottom? It will be at around the IPO price, right? So but in fact, there is no lowest point, but always a lower point. Investor uses the IPO price as bottom of the stock market, as shown in the red line over here. They'd be able to make around 64% loss. And looking at another example, if we see the share prices in this example here plunging very, very fast. And if we were investors who wanted to catch the bottom, where do you think investors will be comfortable to buy at? Because it's dropping like a falling knife. So many people will be afraid. And if they want to catch the bottom, they may use some indicator to buy that is and at around this area, like because it's the lowest point that you have seen ever in this graph already. So investors who time the market, if they are currently here, they will continue to wait. So what happened next? The stock market rallied right after without hitting the bottom, and investors who waited for the bottom end up missing the rally, which again shows that timing the market is actually a loser's game. So why do we So what should we do instead? And the simple answer is to invest regularly. What is regular investing? Well, as the name suggests, it means to invest regularly. And what do we mean by investing regularly? So for example, I suppose that most of you sitting right in front of the camera right now are either still a student who gets allowance, or already working, having a job right now, and you get your monthly salary. And I believe those salary or allowance you get it comes in quite consistently and stable, right? Unless you're working like in the commission-based sales related job. So every month, once you receive your salary or allowance, what do? Of course, part of it will go into all those like daily expenses, or your foods, drinks, beverages, and also some will go into your commitments like your rental, loan installments, PTM, and insurance, right? And often or not, there will be some amount left, and normally we call that savings. And you see this amount to be your monthly savings. Now, we know that savings is a good habit, but we also know that savings account doesn't really have yield good returns, right? Especially for your current account and savings accounts with banks that yield basically low yields, and some don't even have any interest. So, and even if they may go up to 0 to 1, or some might highest to 2%. So, or even if it does, it will come with terms and conditions too. So to ease yourself from dealing all of these troubles, you may consider to put your money into investing. And there you have it. You are getting consistent money from your allowance or salary. You pay yourself with a portion of it on your daily needs, daily expenses, commitments, and you decide to save the rest or invest it. However, investing do comes with risk, the risk of losing your initial amount. Therefore, we will, instead of choosing the right, instead of just investing, we can choose to invest regularly. And in this presentation, there is not much to talk about savings, and we will be covering more on the part of investing and through regular investing. So let's get into it. Why regular investing? Do any of you have any reasons in your mind right now? Some can just think of it. Okay, some have your questions or answers in mind already. Okay, so first of all, ever since like the Russia-Ukraine war breakout, consumers' prices has been seeing rising across the world, and has been the most concerned topic of discussion already. So actually, both Russia and Ukraine are major powerhouses of agricultural products and commodities such as the titanium, palladium, wheat, and corn. And Russia is also the supplies of natural resources such as oil and gas, and it is making up to 14% of the world's total supply in 2021. So as the commodities and energy price hike, the domino effect has caused the price hike in other industries as well, finally lead to a higher inflation rate. And the left chart is showing that historical inflation for the past 25 years. So we can notice that for the most of the time, the inflation ranges between 1 to 4% on average. On your right, and is a diagram that shows the details of inflation in Malaysia for July 2023. So thanks to all of these subsidies by our beloved government, and inflation pressure in Malaysia is so much less scarier than the ones in Western countries. And July 2023 recorded a slowdown in the inflation rate, and it was the lowest for the year. So the group has also the most significant inflation in their proportion for food and non-alcoholic beverages, as well as restaurants and hotels. However, if we just look at the number over here, right, Does it look a bit weird? The number looks pretty normal, right? 2%, okay, normal, but why is the nasi lemak vendor outside my house is selling me like more than 2 times the price it used to be in like 2 years ago? Why am I spending more a month on my grocery bills, right? Have you guys felt that too? So in fact, Malaysians has been feeling the pinch from rising prices of goods, and now coupled with the weakening of ringgit, many are facing more challenges in managing their daily cost of living. So generally, inflation is a very complex phenomenon. It can be good for the economy as it will stimulate economic growth by encouraging consumer spending and encouraging investments to enhance production and technology. However, when rates are too high, it also shows the daily expenses of people are increasing. So with the consideration that your wages, your salaries remains quite constant because it doesn't really have a huge spike from Malaysia's wages, it would cause a huge burden to consumers, and the affected sales will not benefit the businesses as well. And putting your money in like FDs with banks, almost certainly it will never beat inflation. Yes, of course. If you notice, recently FDs offered by the banks are at very, very attractive rates. But actually banks, they are like burning their money for this so-called deposit spikes as they want to replenish their reserves, their books, their balances after losing a lot of deposits when the rates were as low as 1.75% a few years ago. And we know that this wouldn't be able to sustain, given that eventually rates will have to go down, and you will start to lose your money, lose your money to inflation again if you put in FDs. So here are a few examples. Next, we believe that each of us here has multiple life goals that we wish to achieve, right? First and foremost, retirement planning is usually one of the major pieces in financial planning. Imagine this, after you have graduated and started your career, you'll be spending around 25 or 30 years of your life working and accumulating your savings. Once you have reached your retirement, you will not have any like cash inflow, and all you have left is your like savings, EPF, and investments, and these monies will be used to sustain your life for another 15 to 20 years. So with the consideration that inflation keeps on increasing, how much money do you think you need for your retirement planning? Of course, there are some other life goals that you wish to achieve, such as buying your own house, starting a new family, going for like your dream vacations, traveling all around the world, traveling to places that you wish for, and the list goes on. These are the life goals that you hold dearly to yourself, and they need to be funded by a lot of money. Therefore, it's important for us to figure out how we want to get there. And the easiest answer is to save and invest regularly. So a lot of people might be asking, how can regular investing help me to create my wealth? Let's start off with an example of how much can 100 a month worth in the future. Basically, by just investing 100 a month. So I believe that many of you here who are working already have 100, more than 100 or 100, at least 100 a month to spare to invest, right? So let's begin with a simple maths with some basic assumptions. You are starting with no savings and your investments will earn you 5% annually, and you will be retiring at around 60 years old. And I am here to show you 3 different scenarios where you started investing in different ages or holding other factors the same. For a young woman at 18 years old, if you stash 100 ringgit away per month, you will end up around 170,000 ringgit by 60 years old. So if you started 25 years old, you will end up 113,000 by 60 years old. And if you start 30 years old, stashing away 100 ringgit per month earns you 83,000 by 60 years old. So investing in a long period of time lets you to take advantage of the power of compounding interest, which means not only you get the investments, you get the returns on the money you invested, but you're also getting the returns on top of those returns. So now let us move on to what are some of the features of regular saving plan. First, regular saving plans also refers to our regular investing. So first, regular investing has very low requirement. The minimum investments could be as low as 100 ringgit. The next, there's no minimum participation or lock-in period for this. So at any time, you may just decided to just sell all your things. You just don't want to do your regular savings anymore or regular investments anymore. Yes, just feel free to do that. There's no fees required or anything. So unlike installment plan, investors do not need to feel burdened as there is no interest rate charge. And besides, the regular investment allows you to make the most out of your market highs and lows. And by participating a disciplined regular investment contribution, you will be able to buy more units when the price is low and fewer units when the price is high. So eventually your cost will be lower than average. Now, let's take a look at some of the examples on individual equities. Many of you here I believe, do invest in equities, right? Either do Malaysia stocks, US stocks, or maybe other region stocks. So the first example here we have is a family renowned brand. Maybank can be considered the icon for Malaysia Stock Exchange, as it is the largest market capitalization stocks in Malaysia. I believe that all of you here sitting here do know what is Maybank, right? They either you have your credit cards with them, savings account, or even you have taken a loan from them. Yeah, they are the largest capitalized stocks in Malaysia, and it is also one of the retail investors' most favorite blue chip stocks. So the same assumption we apply here. By investing 100 a month into Maybank from 1996 to 2022, and by the end of October 2022, we will end up with a total units of around 12,300, which translated into around 105,000 ringgit Malaysia. So comparing to our total capital invested of around 31,500, which is derived by placing 100 per month into this stock, we will have a capital gain of 235% in 26 years while still receiving dividends every year without reinvesting those dividends earned each year. So basically means that I just get dividends. If I don't reinvest those dividends, a lot of stocks actually they have that options to reinvest. Like if you are longer term stock investors, you may notice that sometimes they will when they issue you dividend, they will ask you whether you want to reinvest those dividends. Yeah, so if you choose to reinvest them, you will have the potential to earn more on top of those returns. So based on the latest filing in 2022, the annual dividend is around 7,134. So just imagine you are receiving 7,000 in a year without needing to do anything, and just investing 100 a month each year. So meanwhile, if we choose to invest in like FDs for 2.9% per annum, this 2.59% is the average. We use the average FD rate throughout 1996 to 2022. So we will end up with a total amount of around 46,500 ringgit Malaysia. This 46,500 is a huge amount, but it is nothing compared to if I invested in Maybank, even assuming that interests are compounded. Now, here's another example. DG, a family renowned brand, also a family renowned brand, who supplies your data plan, telecommunication networks, same thing. If we invest 100 per month into DG since 1997, by the end of October 2022, we will end up with a total units of around 87,500, which translated into 331,000 ringgit Malaysia. Comparing to our total capital invested of around 30,000, which is derived from by placing 100 per month into the stocks, same thing, we will have a capital gain of around 1,000% in 25 years while still receiving dividends each year without reinvesting those dividends. Same like the case just now. And based on the latest filing of 2022, you will be entitled for an annual dividend for 2022 of a total 11,369 ringgit. So imagine doing nothing every day, and then a year you can get around more than 11,000 ringgit. And then just also given that your dividends are not reinvested. So meanwhile, if we choose to invest in FD with the same 2.9%, we will end up with a total amount of around 44,000. So similarly, it's quite a huge amount, but it is nothing compared to if I invested in DG, even assuming that interests are compounded and my dividends are not compounded because I did not choose to reinvest them. So until now, it looks like investing really helps out in terms of wealth creation. However, investors are constantly confronted with the questions to whether you should lump sum or dollar cost averaging if you suddenly have a decent amount of money ready to invest. Like, let's say you hit a lottery and you get a huge amount of money at just one time, and then, or even suddenly your company performed very great and suddenly decided to provide you a like 12 months bonus, and suddenly you have huge amount of money ready to deploy. So when it comes to then, you will have something in mind whether should I just lump sum invest in one, or should I do it on investing like a portion of it on a regular basis. So before we get into this, we need to know what are some of the benefits of dollar cost averaging. So dollar cost averaging is, okay, let's say the regular investing method uses the concept of dollar cost averaging, which is widely used by Warren Buffett as well. So first, dollar cost averaging it is basically the regular investing. So first, it allows risk reduction. Dollar cost averaging is avoids the disadvantages of lump sum investing through the purchase of a security when its prices are artificially inflated due to like market sentiment. Because as I mentioned just now, when I get a 12 months bonus, my company do very good, and often or not, the entire economical environment is doing pretty great as well. Like many of the industries are performing very great, business cycles are good, this economic environment is good. So not just your company, even many companies might be doing very great. And more often than not, at that time, a lot of share prices for these companies is already at very high levels. So when you do lump sum investment into those companies, you may face some risk. Let's say if I invested in AirAsia, like I think that AirAsia will do great in 2020 before the COVID-19 pandemic. I think that AirAsia will see upside because we are seeing more and more influx of tourists, more and more people are willing to spend more on discretionary income on their traveling. So I decided to buy AirAsia, but then suddenly something unfavorable happened, like the COVID-19. So you will lose a lot of money because business can't operate, your planes, your flights can't fly. So this has caused its share prices to tumble by a lot. And if you buy at a high price lump sum, you will face a huge decline in your value of your portfolio. So if you do dollar cost, you can even if you buy at somewhat high prices, but you are able to average down as the share prices tumbles. So eventually your average cost will be quite low, and it's more easily to break even. So when the security price discovers its intrinsic value, prices through the market correction or a bubble burst, an investor's portfolio will decline. And a declining market is often viewed as a buying opportunity. Hence, dollar cost averaging can significantly boost long-term portfolio return potential when the market starts to rise. Next, the benefit is disciplined savings. The strategy of adding money regularly to an investment account allows disciplined savings. As investors build the habit of setting aside some money for investment on a monthly basis rather than using up all of it after receiving your salary. So it also helps you to have this good habit of savings. Next, write-off market volatility. Investing a lump sum at the wrong time can be very risky, which can adversely affect a portfolio's value significantly. It is difficult to predict market swings. Hence, the dollar cost averaging strategy will provide a smoothing of the cost of purchase, which can benefit the investors. So another strategy that mistakes that traps investors are to time the market, especially when pricing trends are going down and investors are trying to read the chart, look at the chart, and trying to catch the bottom, and then only they realize that they are lower low compared to previous low. So just when you think you're unable to bear the losses and you started to stress anymore and decided to sell your investments, and then comes a recovery and you misses it. So these are the market noises that are messing around in your head, and it influences you to make unsound or not so reasonable decisions, bad decisions, I mean. So the last benefit is also quite important to us, which is psychological biases and timing the market. So dollar cost averaging helps you to build emotional resilience. So to me, I believe that psychological biases is very important and very significant to any investors. No matter you are new investors, you are experienced investors, you get into psychological biases. It just depends, it's more or less. So for example, you might hear some rumors saying that some investments are going to fly, right? You say, oh, maybe through your friends or what, it tells you he's telling you that, oh, I've heard some lubang saying that, oh, this investment is a good pick, it is going to increase to it might gain 20 or 30% in the next 1 month. And then but at that time when you look at it yourself, you don't believe it because maybe you have read the charts or you have studied their fundamentals of company. To you, it's not so attractive, but then it doesn't, you don't believe that you'll go to that price. But when you see it going up slowly, even if a little bit, you start to doubt yourself. Maybe there's actually some news coming up soon. So then you just lost your those are psychological biases that you lost your emotion, and then you just buy into it, and then you just lose, you just fall into the trap. So next, let us dive into how dollar cost averaging can help investors to weather through market volatility. So one of the question is, do you know that if an investment is down around 50%, it needs not 50%, but 100% for it to get back to your initial capital? However, if your investment is down 60%, some investors might think, I need 120% to recover if I based on the previous example. But in fact, no, investors will need 150% to break even. That's why in order to recover your losses faster, investors will need to rely on dollar cost averaging. DCA, dollar cost averaging, is a simple strategy that involves investing in the same fund or stock at different intervals. Investors can dollar cost averaging during downturns by bringing down the average investment cost and speed up the recovery process. Let's say for the first case of if there is a down 50% down, if investors were to dollar cost averaging it by buying the same amount invested, the investment will only need to rebound like 33.33% for investors to break even compared to the 100% rebound needed earlier. And this 33% rebound is so much more easier to achieve compared to the 100% rebound. So if you remember, so if investors dollar cost averaging into the 60% drawdown, the investments needed to rebound by only 42.6% to break even instead of the 150% mentioned earlier. Though this shows that dollar cost averaging during downturns is effective in bringing down the average investment cost and speed up the recovery process. And this slide here shows the investment recovery table. It shows that for each percentage losses, how much return or rebound is needed to recover the losses if we do not do anything, as well as how much return is needed if we dollar cost averaging it 30%, 50%, 100%, or 125% of the initial cost. So the larger the amount, the result is the larger the amount we dollar cost averaging it, the less return it needed to generate to break even. So during the year 2022, right, because of the Fed hike rates causing a lot of stocks to suffer, and then you also have the Russia-Ukraine war, every people was afraid. At that time, a lot of stocks experienced like more than 50% of losses, right, if you do remember. So if investors do not do anything, they need to gain at least 100% in order to break even. But with dollar cost averaging, the required return is much lesser. And 125% of dollar cost averaging of initial capital will leave only around 30% needed to break even. Way much easier than waiting for it to if you do nothing. So and then if you use S&P 500 as an example, you already break even. If you do dollar cost averaging or even generating some positive returns already. So now let's backtest the strategy of using past market downturns in Asian equities to illustrate the power of dollar cost averaging. So let's say an investors invested 100,000 during the global financial crisis at here in May 2008, and by doing nothing, they'll need to wait until 2 years later here to break even during October and 2010. So through dollar cost averaging 100% at here of initial capital in October 2008, investors are able to recover their losses in less than 1 year at here, way much more earlier than you need to if you do nothing. Now let's take a look at an example of an incident of China hard landing and circuit breaker. So the maximum drawdown is at around negative 37.5% at that time. If investors were to invest in 100,000 in May 2015, they will need to wait until 2 years later in 2017 to in order to break even to recover their losses without doing dollar cost averaging. However, if they dollar cost averaging 100% in January 2016, investors are able to break even in August 2016, way much faster than do it without dollar cost averaging. So lastly, if investors were to invest 100,000 during the US-China trade war in January 2018 and dollar cost averaging in October 2018 at a loss of 21.5%, they will be able to break even in March 2019. Without dollar cost averaging, they will need to wait another like 1.5 years to break even. So let us see an example of a side-to-side breakdown. Using the public bank example, another family very popular brand, very popular stock for investors as well. If we invest 4,700 into public bank from 2018 to 2021, either through lump sum or monthly dollar cost averaging of 100, during this period, the outbreak of COVID-19 pandemic has caused a massive sell-off of the stocks, and maximum drawdown was around 38.1%. By the end of 2021, we will end up with 4,842 for lump sum investment and 5,111 for dollar cost averaging, with the same capital invested of 4,700. So the return in percentage is at around 3% and 8.7% respectively. So you can see that this chart here shows that if you dollar cost averaging, your returns are going on a straight line basis going up. But if you just lump sum investment, you may face very, very volatile ups and downs. This shows that dollar cost averaging is able to speed up the recovery process. So why dollar cost averaging is the best method to invest during volatile market? Because hindsight bias is, how do I know if tomorrow stock market will up or down? It's because if tomorrow happens tomorrow night, I will know by then. But so this is hindsight bias. So especially in volatile markets, dollar cost averaging can help investors to avoid big on paper short-term losses compared to if they had invested all their money at once on what happened to be the wrong day. You won't benefit from a full investment if you happen to invest at the bottom of the market, but you could also avoid buying all the shares on the top only to plunge into like a bear market. Since we already know that the best time to invest is in hindsight, dollar cost averaging helps reduce the risk of getting extreme outcome, whether it is positive or negative outcome. So that means that because all you want to do, your objective is to plan for your retirement. So you don't need to take on that much of the risk. You have a lot of risks. You want stable returns. You want stable and secure and conservative returns. So dollar cost averaging helps you to reduce a lot of noises in the market, in your investments, and help you to secure more and to generate more stable returns. You might sacrifice some huge gains, but you also help you to protect your portfolios away from some huge losses. So here are some examples of the return difference between dollar cost averaging and lump sum investment due to certain market events for each stock. Averaging outperform lump sum investment in almost all of the market-based events, especially during the dot-com bubble in the early 20th century. Meanwhile, this is same with Maybank. As you can see, even during huge downturns, the dollar cost method recorded lesser drawdown. Some even generated positive returns, like during the dot-com bubble where it delivered 2.8% compared to a lump sum investment when the lump sum investment is down 20.7%. So it basically means that when people are still losing 20.7% on their portfolio, you are actually generating positive returns already. So also, this regular savings apply to like unit trust as well. You can use it across many products. It applies to like your stocks, ETFs, and unit trust as well. For unit trust, let's just start from unit trust. For unit trust, where we call it the RSP method, which is regular savings plan. It shows its ability to better weather through market uncertainties in a volatile market by recording lesser drawdowns. Regular savings plan, also called RSP, is a regular subscription plan for funds investment. It uses the concept of dollar cost averaging. And dollar cost averaging is an investment strategy which investors place a fixed amount of money into an investment on a regular basis. And it is a very popular method of investing that used by one of the most successful investors, which is Warren Buffett. Basically, regular savings plans is about investing a fixed amount of money in the relevant funds recurringly, regardless of market conditions. So this will cause like fewer units being bought when prices are high, whereas more units are bought when the prices are low. As a result, in a rising and fluctuating market, the average cost of all of the units can be lower than the average price during the same period. This allows them to profit from market dips by purchasing more shares when the price is lower, without the nerves that some investors often have when they see the value of their investment dips. Basically, you just don't need to look at what are the market conditions currently. You just buy regularly, buy it on a regular basis, and just leave it there. And over time, the accumulated sum at the end of the period will increase. So for investors, basically just pick the same stock, right? So figure out how much you can afford to invest, and then commit to buying shares at the preset intervals. It's very simple, as anyone who has a proper investment account can use this investment method. Even have their account set up to automatically invest in the money in a vehicle of choice when the money is deposited at on the predetermined schedule. So if investors are to invest, let me show you an example here. I think I had it. So yeah, you can just basically link your salary bank account to our cash account, and then it will help you do the regular savings plan monthly on your fund portfolio. Or even the same goes to ETF as well. ETF are exchange traded fund that tracks various famous indexes that helps you to do like a passive investing. You can choose to invest in like famous ETFs such as VOO, which is the S&P 500 index ETF. It tracks the performance of S&P 500, which is one of the world's largest stock indexes. So basically, it outperformed many kind of investments. So if you do remember, if you have seen before, the performance of S&P 500, it's like an evergreen stock market, and if you look at it from a long-term perspective, it is always going up. So by doing RSP on let's say the S&P 500 index ETF, it will help you for your portfolio to follow the performance of the S&P 500 index and use sustainable secure returns in the future. So okay, so this one. Okay, so if investors are interested in the regular savings plan but have no idea on which unit trust to choose from, here are some of the recommended unit trust funds for each regions that are available for RSP in our platform. Just basically look it up in our platform, and it's all available there. And this table here, this chart here, shows that where we think opportunities currently lies. Currently, we prefer Japan due to the accommodative monetary policy stance from the Bank of Japan, milder inflation also, reopening play, and attractive valuations. We also like other Asian countries such as Singapore, South Korea, and as well as Taiwan. Although Malaysia here is 3.5 stars, but we recommend investors to be a little bit cautious as the economy continues to face political uncertainties after the tabulation of budget. So a retirement also, we have the private retirement schemes, which are called PRS. It is a voluntary long-term savings and investment scheme designed to help individuals in Malaysia to accumulate savings for their retirement. So these schemes are actually regulated by the Securities Commission of Malaysia and aims to provide individuals with an additional avenue for retirement savings beyond mandatory contributions to the EPF. So it helps you to build your long-term portfolio and then to have some really plan for your retirement, because some people, they have troubles in having like disciplined savings. So buying in private retirement schemes helps you to solve this issue, because first of all, they have tax incentives that Malaysia government provides tax incentives up to 3,000 ringgit to encourage participants in this PRS. So they can enjoy like tax deductions up to 3,000 on their PRS contribution, providing additional incentives for retirement savings. Whereas for normal unit trust, you don't have this kind of incentives. And also it is very retirement focused, because the funds are managed with the goal of providing participants with a source of income and or capital for their retirement age. So they actually have some lock-in period that you won't be able to sell within a few years. So and then so that allows you to really build up the habit of savings for investments. So many of participants that has their PRS account can only withdraw upon reaching the age of 55, or due to other like qualifying events such as permanent disability or emigrations. So as much as dollar cost averaging is very effective, there are some factors that you need to consider to fully utilize the strategy, which are first, investment objective. Investment objective refers to what do you actually want to, why do you invest? What do you want to achieve in the future? Like some might be buying a house, some might be having a stable returns of for upon retirement. So next you will need to look into a risk profile. Some people are able to take on more risk, especially for younger people who have already stable income and then less commitments. So young, when you're still young at your age, you have a lot more years to work until you reach your retirement age. So with that, you are able to like take on more risk. But for other people who are near their retirement age already, are going to retire soon already, they are not able to take on so much risk, and they are more conservative, so they need to choose investments that are more conservative in nature, more defensive in nature, like a lot of all those bond funds or even bond papers. Also, you need to know the background of the index. You need to do research on your investments before you start investing in it. And also, expense ratio is an important characteristic to look at, because high expense ratio can really eat into your profits. And also liquidity and trading volume. Liquidity and trading volume is very important, because when the liquidity is thin, low liquidity in the market, but even if your investments are generating you a lot of returns already, but if you are when liquidity is thin, you are unable to sell those, and thus you will face higher so you won't be able to realize such profits. So investing, here, before we end, we have before I end my presentation here, I would like to take a quote from Benjamin Graham, a very famous investor, and he has published a book called The Intelligent Investors. Don't know if you guys have heard it before. So this quote is about the best way to measure your investing success is not by whether you are beating the market, but by whether you have put in place a financial plan and a behavioral discipline that are likely to get you where you want to go. All in all, here are some key takeaways from this session. The stock market is no place to invest for quick returns. While dollar cost averaging can help to reduce short-term impact of price swings on your performance, consider focusing on the long-term goals you are invested in for instead. Time in the market is always better than timing the market over the long term. And history shows that the longer you stay invested in the stock market, the better of your chances of making money. Investing in extreme market conditions is difficult, and dollar cost averaging helps investors to stick to their plan and when they have their capital to put into work. With that, I've come to the end of my presentation. And now let us move on to the Q&A session. Are there any specific, the first question is, are there any specific economic or market conditions you should pay attention when managing a regular savings plan? So when it comes to regular savings, it is always good to, if you do not have the time to keep on look at the stock market, and it is very good to take on this strategy when there is high volatility in the market, especially now. If we don't have a good view on whether we think what will happen to the stock market in the next 6 to 10 years, 10 months, because soon after or not, you have Israel and Palestine still fighting against each other, and who in the hell will know that when will other big countries like Saudi or other oil major countries join the war and escalate the war to another, take this war to another level, which will greatly impact your oil prices, which will cause another downfall in the stock market. And also currently you have your US earnings seasons undergoing anyway, and then next year we don't know when will Fed actually cuts its rates, but and then you have next year you have the US presidential election going on at the same time. So there are a lot of things in the market currently, and there are still a lot that is in the pipeline for the next 6 to 12 months. So so there are still a lot of uncertainties, and we do not know when we do not have a very good view of whether what will happen in the next 6 to 12 months. So in such volatile markets, it is very, very prudent, and it is very good to be prudent and then take on to do your regular savings plan. So, okay. Okay, next one, how does regular savings plan differ from one-time lump sum investment in terms of impact on the market movement? So when you are having a up market, the stock keeps going up. At that time, if you do regular savings plan, you do regular investing, you will lose dollar cost averaging because you are buying when the prices are going up, right? Instead of a lump sum investment, buy at a low point and then the market keeps going up. So, but first, there are a few questions you need to ask yourself. Do you know that market will keep on going up from this point of time? If no, why you need to take the risk of going lump sum investment? And secondly, do you have that kind of huge amount of money already ready to deploy at current levels? So these are some of the points that you need to ask yourself, and also be aware of it. Okay. Okay, this one about a cash management fund too. Yes, it is only currently available in ringgit. So we currently for our platform we do not have any US dollar cash management fund. I know US dollar is giving out pretty great yields, pretty great rates, but currently we do not have any US dollar class for our cash management funds. So, but in the future we might consider. We are still on talks on maybe taking in some. So for these funds, you are able to do RSP, yes. Next, in the context of RSP, how do you address the challenge of managing risk and volatility in the market? Yes, RSP itself is already one of the strategy to manage volatility because it helps you buy more units when the price are low and less units and the price when the prices are high. So eventually your average price will be lower, and then the accumulated sum will increase accordingly with the stock market. So so it is very good in investing in very volatile market, especially when ups and downs are unpredictable. So so it's already part of the strategy. And another way to manage risk is to take on a more conservative approach when it comes to investment. Especially you can choose to invest in like bond funds or bond papers especially when things are so volatile, so uncertain at the current juncture, and your yields on your bonds are giving you high returns. So and also bonds are considered to be quite conservative in nature. So it is also a good choice for investors when you want to manage your risk in your portfolio. Okay, maybe due to time constraint, I will take another one more question. For unit trust RSP, what kind of fund is recommended? Yes, we have a recommended fund list available in our platform, and when you can go to this page, choose RSP list, and then you can see a list of funds, and then you can compare it with the recommended fund list that is already available in our platform. If you need any help, just approach any of our customer investment team, advisory team, so they will help you out. And then you just choose any of the recommended funds that we already recommend in our platform, and it differs between regions, such as if you want Malaysia fund or Asia funds or US funds or global funds, you can choose all from it. So you can just basically look it from the list there. And then I think most of the funds in that list are available to do RSP. Yep. And I hope that answers your question. So I see now the time we have already off a little bit. It's already 9 p.m. already, more over 9 p.m. So I guess let's call it a day. And thank you all for joining me here in this sharing today. And I hope you get something insightful and fruitful from this presentation. And if you need any more questions that I didn't get to address here, you can feel free to approach any of our customer service to seek help. Okay, thank you all, and hope you had a great night. Thank you.